Okay, welcome to the deep dive. So, you've handed us a couple of interesting sources for today. We've got the Goldman Sachs Shareholder Letter from 2021, and also this separate document, which is just, well, a list of interview questions.
Right. A bit of an unusual pairing, maybe.
Yeah, maybe. But our mission here is pretty clear. Dive only into these documents you gave us.
Hmm.
We want to pull out the essential nuggets, the key takeaways, really, to help you get a quick handle on how Goldman Sachs did in 2021, what their strategy looked like going forward, and, what they thought was most important to tell shareholders back then.
Exactly. We're sticking strictly to what's in these pages, focusing on what the firm itself chose to highlight in that shareholder letter, trying to separate the signal from the noise based only on this material.
And right off the bat, the letter grabs you. It calls 2021 an extraordinary year
Yeah.
with exceptional results. But then, almost in the same breath, it talks about a challenging and incredibly dynamic market environment.
Mm-hmm. That contrast is definitely there.
So how do they explain that? Achieving exceptional results while things are challenging. Let's dig into that.
Well, they start, maybe unsurprisingly, with the big financial numbers, the stuff shareholders really focus on. And yeah, the 2021 figures they lead with are pretty striking.
They really are. Okay, top line numbers, record net revenues, $59.34 billion, record net earnings, $21.64 billion, and record diluted earnings per common share, $59.45. Just massive numbers.
And they don't just stop there. They give profitability metrics relative to the capital shareholders have invested. So return on average common shareholders' equity ROE that came in at 23.0%. And they make a point of saying that's the highest it had been since 2007.
Well, this is before the financial crisis then.
Exactly. And then there's return on average tangible common shareholders' equity ROE, which was 24.3%.
Okay, let's just quickly clarify those. Based on their own definitions in the back, ROEE, they say that's net earnings relative to the tangible common equity. So excluding things like goodwill, right?
Sure.
That's physical stuff.
Yeah, precisely. It's meant to give a sense of return on the core physical capital base. They say management uses it to compare performance. ROE is similar, but includes those intangible assets you mentioned.
So basically, these numbers tell you how well the company's using shareholder money to make more money.
That's the gist of it, yeah. High ROE and ROTE suggest they were very profitable relative to their capital base that year. And hitting levels not seen since 2007, well, that's a story they clearly wanted to tell.
Right. But they did this in that incredibly dynamic market environment. How did they manage that, according to the letter? Did the chaos help?
Well, they mention a big tailwind from the surge in capital markets activity. Think M&A, IPOs, trading, that came with the economic recovery. So high activity levels were definitely a boost for certain parts of their business.
Okay, so the level of activity helped.
Yes, but they immediately pivot to the challenges too. They talk about pressure on supply chains leading to, quote, decades high inflation. And they flag that by the end of 2021, things were already shifting. The market was entering a new period of uncertainty because everyone expected interest rates to start going up.
Ah, okay. So it's like they rode the wave of activity in 2021, but could see the waters getting rougher ahead. For you listening, I think seeing these huge numbers next to the talk of challenges gives you a better feel for their narrative. Like, look how well we did despite the difficult environment.
Exactly. It frames the success. It wasn't just a free ride, is the message.
Okay, so that covers the look back at 2021. What about the outlook for 2022 based on this letter?
They're pretty upfront about it. They say, and I'm quoting here, "We don't expect 2022 to look like 2021, especially as monetary policy tightens and fiscal policy becomes less supportive."
Right. Acknowledging those tailwinds might fade.
Definitely a dose of realism. But then they immediately follow up with confidence. They say, "Our confidence is as strong as it's ever been that our strategy is working and that we can help our clients navigate whatever the future holds."
So the strategy is the key then. If 2022 is going to be different, how does their strategy laid out here help them navigate it?
Well, they refer back to the plan they set out in January 2020. It had three main parts. One, grow and strengthen their core existing businesses.
Okay.
Two, diversify into new products and services. And three, operate more efficiently. And the overall goal they state is to produce higher, more consistent returns.
And they seem pretty pleased with their progress. They mentioned tracking KPIs and expecting to hit most of them.
Yeah, they say they track over 30 key performance indicators and believe they'll meet or exceed 95% of them. And they really hammer home that a renewed focus on clients is key to all this. They call it the One Goldman Sachs initiative.
Right, aiming for that more comprehensive and integrated service.
And there's that quote about their core belief regarding clients.
Oh yeah, I marked that. That if you really take care of your clients, if you invest in those relationships, and if you build trust over a long period of time, good things will happen. It really grounds the strategy.
It does. It suggests they see relationships as fundamental, not just transactions. And they tie all this back to their stated core values: partnership, client service, integrity, excellence. Plus a whole list of business principles, things like clients first, protecting reputation, shareholder returns, teamwork, honesty.
It's quite a list. It gives you a sense of their official operating philosophy.
So you've got the strategy, the what they want to do, and then the client focus and values, the how they say they want to do it. It paints a picture of their intended approach.
Yeah, it connects the dots between the business goals and the sort of cultural framework.
Yeah.
For you listening, it makes you think, how important is having that clear strategy and that focus on who you're serving in your own work?
Good question. And they don't just leave it at the high level. They get specific with targets.
All right, the numbers. They updated their medium-term financial targets. What were those again?
ROE of 14-16% and RD of 15-17%. So lower than the 2021 highs, but aiming for consistently strong profitability. And an efficiency ratio target of approximately 60%.
And the efficiency ratio, just to remind ourselves, is basically costs as a percentage of revenue. Lower is better.
Generally, yes. So aiming for around 60 cents of costs for every dollar of revenue. They also mentioned keeping a certain level of regulatory capital, the Tier 1 ratio, with a buffer.
Got it. And then they had specific growth targets for different business areas, right, for the period up to 2024.
Yeah, really specific ones, like $350 billion in new organic fee-based assets under supervision, that's client money coming in for the long term, and $225 billion in gross fundraising for alternatives, things like private equity, real estate.
And revenue targets, too, for those growth areas they're focusing on, like transaction banking, aiming for around $750 million in revenue by 2024, and consumer banking, targeting over $4 billion.
Exactly. These numbers make the strategy concrete. They turn the concepts into measurable goals they're putting out there publicly.
Okay, so let's see how this strategy actually played out in their different business segments in that extraordinary 2021. The letter says all 4 segments grew revenue year over year.
Starting with investment banking. Record revenues, $14.88 billion. They boast about being #1 in M&A, equity offerings, IPOs according to Dealogic. Revenue was up a huge 58% from 2020.
And they mentioned growing wallet share.
Right, basically their slice of the total market fees. They say they grew it by about 350 basis points over 2 years. That suggests they were taking market share from competitors. They also noted a strong backlog heading into 2022.
Okay, what about global markets?
Also strong. $22.08 billion in revenue, their highest in 12 years, they say. Overall revenue up 4%, but equities trading did particularly well, up 20%. And they grew wallet share here, too, about 250 basis points since 2019, claiming top 3 status with most of their top institutional clients.
And asset management had a really dramatic jump.
Yeah, that was the biggest percentage increase. Record revenues of $14.92 billion, up 87%. Wow. Fueled by investments, presumably strong market performance, and fees. They stress they're focusing strategically on building more predictable, durable fee income here.
And they mentioned reaching $2.5 trillion in assets under supervision firm-wide.
That's right. And they mentioned the planned acquisition of NN Investment Partners, highlighting its ESG environmental, social governance focus, and European presence.
Okay, and the last segment, consumer and wealth management.
Also, record revenues, $7.47 billion, up 25%. Wealth management drove a lot of that record $5.98 billion, also up 25%, from more client assets, alternative investments, lending. Consumer banking, think credit cards like Apple Card. Marcus deposits also hit a record $1.49 billion, up 23%.
So across the board, growth in 2021, these highlights really show that grow and strengthen part of the strategy delivering, helped by those market tailwinds.
Definitely. And they link this performance directly to progress on those specific growth initiatives they keep talking about.
Like transaction banking, TXB.
Yeah, they seem really excited about this. They talk up their cloud-based platform, expanding it to the UK. Say they've got about 350 corporate clients now, plus partnerships with folks like Amex and Stripe. And they blew past an earlier deposit target aimed for $50 billion, got it early, so they set a new target for 2024 of over $100 billion in deposits.
And they expect it to boost overall profitability eventually.
Yeah, they say it should be accretive to ROE at scale, meaning as it gets bigger, it should help lift their overall return on equity.
Okay, and alternatives. That fundraising target was huge.
It really was. They positioned themselves as a top 5 global player, raised $67 billion just in 2021, bringing the total since the strategy started to $107 billion. That's why they upped the 2024 target so much to $225 billion. They also mentioned cashing out some of their older on-balance sheet investments.
And then digital consumer banking, or Marcus.
Right. It hit its 5-year anniversary. They tout over 10 million customers, $110 billion in deposits, emphasizing the customer focus. And the letter mentions the deal to buy Green Sky, that fintech doing home improvement loans.
So that looks like a way to expand their consumer reach significantly.
Seems like it. They also mentioned new products like the Apple Card Family Plan and a GM Rewards card with digital checking plan for 2022.
So these examples, the client numbers, the deposit growth, the acquisitions like Green Sky, they really flesh out how Goldman Sachs says they're executing on growth and diversification.
Absolutely. It connects the strategy paper to tangible actions and reported results.
Now, what about the third leg of the strategy? Operating more efficiently.
Okay, so the letter acknowledges operating expenses were up 10% in 2021, and the main driver was compensation, which jumped 33%.
Wow, 33% increase in comp.
Yeah, but they quickly point out that the compensation ratio comp relative to revenues actually went down. They link this to the record revenues and their pay-for-performance philosophy. And they reiterate that target efficiency ratio of around 60%.
So even though spending went up, especially on people, they frame it as being efficient relative to the massive revenues they brought in.
That seems to be the argument. They also mentioned they've achieved about $1 billion of a planned $1.3 billion in permanent annual cost savings.
How does technology fit into this efficiency picture?
They stress that technology and engineering are important to the future. It's key for things like transaction banking, the Apple Card, but also for internal efficiency. They talk about creating cloud-based developer platforms and launching something called Financial Cloud Data at AWS, basically offering data tools to outside developers. Recruiting engineers is mentioned as a priority.
And this ties into their focus on people and culture.
Very much so. They give a lot of credit to their people for the success, highlighting a distinctly collaborative culture. There's a whole section on the importance of getting people back together in the office, especially for junior staff, to foster what they call the apprenticeship culture and transmit those core values, partnership, client service, etc.
So they acknowledge flexibility is needed, but they seem to really believe in the value of in-person connection for their specific culture.
Yes, they explicitly say they believe they're stronger when we're together. So you see this interplay. Investing in people through pay, investing in tech for growth and maybe efficiency down the line, managing costs, but also really emphasizing culture as a strategic asset they need to nurture, partly through being physically present.
It's a complex balance. You know, for you listening, it's interesting to think about how any organization weighs investment in its people and tools against the constant pressure for efficiency.
Definitely. And the letter doesn't stop at just business operations. It goes broader.
Right. There are big sections on sustainability and diversity and inclusion.
On sustainability, they emphasize it's increasingly important for clients. They highlight their goal to mobilize $750 billion in sustainable finance, investment, and advice by 2030. And they say they'd already reached about $300 billion towards that by the end of 2021.
$300 billion a lot. Did they break that down?
Yeah, they mentioned themes like $167 billion for climate transition and $50 billion for inclusive growth. They also talk about aligning their own financing activities with a net zero by 2050 goal and setting interim targets for specific sectors like oil and gas, power, and auto manufacturing.
So they see their role as helping clients decarbonize.
That's how they frame it. Drive decarbonization in the real economy in partnership with our clients. They mentioned developing tools, too, like an open source platform for climate data and something called carbon portfolio analytics.
And they call for collaboration.
Yes, public and private sector collaboration, and directing capital towards sustainable solutions, especially in emerging markets. So they're presenting sustainability not just as doing good, but as a core business driver responding to client needs.
And what about diversity and inclusion?
They call it a top priority. One concrete action they highlight is strengthening their board diversity rule for companies they take public in the US and Western Europe, requiring at least 2 diverse board members, including at least 1 woman.
That's quite specific.
It is. They also talk more broadly about addressing the opportunity gap through investments and philanthropy, mentioning progress on their own internal hiring goals, claiming the most diverse managing director class to date, but also admitting there's much work to do on building diverse leadership.
And they detail some specific initiatives here too, right? Like 1 million Black women.
Yes, launched in March 2021. The goal is $10 billion in investment capital and $100 million in philanthropic support to impact at least 1 million Black women by 2030.
And they reported some early progress.
Yeah, they said investments and grants had already impacted over 98,000 women by year-end 2021. They stress it's based on input gathered from nearly 20,000 Black women and girls. They mentioned specific programs for sole proprietors and nonprofits, and a microloan partnership with Grameen.
And the other big one was Goldman Sachs, 10,000 small businesses.
Right, their long-running program providing education and support. They say it served over 12,300 small business owners. They mentioned expanding it with things like a fellowship program pairing college students with alumni businesses for paid internships funded by the GS Foundation, and an advocacy arm called 10,000 Small Business Voices.
Which apparently worked on policy changes.
Yeah, they mentioned working with the Biden administration on things like expanding disaster loans, EIDL, and reforming federal procurement to help small businesses.
So similar to sustainability, they're framing D&I not just as external initiative, but as integral to their firm, their people, their clients, and their impact on the economy.
Exactly. It shows the breadth of topics they felt were important to communicate directly to shareholders in this main annual document.
Yeah.
For you listening, it's interesting to see how these large firms are weaving social and environmental goals into their corporate narrative alongside the financials.
Okay, now there was that other source document you included, the list of questions.
Yes, the list of over 60 potential interview questions.
Completely generic, right? Categories like personal, work and career, mindset, creativity, life lessons. Nothing specific to Goldman Sachs.
Correct. Just a broad list.
So this formal shareholder letter obviously doesn't answer questions like what's your biggest failure or what makes you laugh. But including that list alongside the letter, what does that suggest? Why look at both?
Well, I think it's a useful prompt. It reminds us that behind the official corporate communication, the numbers, the strategy points, the carefully crafted initiatives we've been discussing there are, well, people, leaders making decisions, a workforce executing plans, a whole organizational culture.
Right.
The shareholder letter gives you the firm's intended message, the official story, but that list of questions points to all the other dimensions you might explore to understand an organization more deeply: the leadership philosophy, the approach to innovation, the human element, the lessons learned for setbacks, things that don't usually make it into a formal report.
Yeah, it's like contrasting the polished surface with the potential depth underneath. It highlights that while our deep dive today is strictly focused on the content of the letter itself, a really full understanding would probably involve exploring some of those other more human aspects hinted at by those kinds of questions.
Exactly. It frames the limits of what a document like this can tell you while still showing how much information is packed into it.
Okay, well that brings us towards the end of this deep dive, sticking just to the sources you gave us. We've unpacked those record 2021 results, seen how Goldman Sachs links them to their strategy operating in a dynamic market. We've looked at their three-part plan: grow, diversify, be efficient with those really specific targets for areas like transaction banking, alternatives, and consumer digital.
We also touched on their focus on technology and culture as enablers, and those significant sections on sustainability and diversity and inclusion initiatives, all filtered through what they chose to present in that 2021 letter.
It's been fascinating to dissect it this way. Thanks for joining me on this deep dive.
My pleasure. And maybe one final thought for you, the listener, to chew on, based purely on what we read in the letter. It paints this picture of huge financial success driven by strategy and boosted by market conditions in 2021. But it also puts a lot of emphasis on culture, on people, and on these big societal impact initiatives like 1 million Black women and their sustainability goals. So thinking only about what's in the letter, what might be the biggest challenge for Goldman Sachs going forward from that point? specifically balancing that explicit goal of delivering superior returns to our shareholders with that equally strong emphasis on making progress promoting change in the world at large, especially as they anticipated a tougher market environment in 2022 compared to that extraordinary year. It feels like a core tension sitting right there in the document.